Want to welcome everybody today to thanks for joining me today. I want to thank you so much and welcome you to our webinar today on the post-election market outlook. What happens now? Now that we're done with the election, or for the most part, what does the economic landscape look like? What does the stock market look like going forward from here? 2020 has been just a crazy ride, obviously. We've been through a lot of stuff in 2020. We had a 30% sell-off in early this year as the pandemic started surging around the country in February and March of this year. And then subsequently, the market recovered, and it recovered very quickly, which was really surprising. It's been really kind of a crazy, wacky year. A lot of weird stuff has happened. I think a lot of people are just ready to be done with 2020. Here in Cincinnati, we had a fire on the main bridge, I-71, that goes across the Ohio River that handles like 180,000 cars a day. and needless to say, it's really ruined traffic. And I was talking with a client earlier, like, what more can 2020 bring us? I'm pretty ready to flip the page on 2020 and go to the next year. Welcome to everyone who has just joined us. Welcome to you if you've just joined me on the call here today. I want to thank you so much for spending a little bit of time with me today and giving me a few minutes of your time. With everything going on, 2020, I think the theme of 2020 is loneliness. Usually I have a few events that I do during the year, but it's been just kind of a lonely year. It really has. And so I'm excited today to spend a few minutes with you talking about the post-election market outlook. And what do we expect going forward? I don't think anyone kind of expected the market to do what it did in 2020. It was kind of one of those crazy years. And so now here we are after the election is over with. Coronavirus is, we can see the light at the end of the tunnel, at least. I know right now it's very bad, but there is some hope on the horizon. And so what do we expect going forward? We got a great attendance here today. A lot of folks on the call. And if you are here, I want to welcome you. Thank you so much for joining me and spending some time with me today. If you want, please, if you could, send me a quick thumbs up or a hello in the chat, just so I know that people can hear me and I'm not just talking to the airwaves. So there should be a chat button up in the corner. You can click on the chat button and it'll open the chat. And you can just send me a quick hi or hello or good afternoon or smiley face or something, so I know that, oh, great. Okay, I see some messages coming through. Good. So folks can hear me. I'm glad about that. All right. So let's go ahead and get started. I'm sure there will be a few more who are joining us as we go. This is going to be real informal, so I just wanted to set this up. I was thinking the other day, I was like, you know what? I'm kind of bored. Business hasn't been super busy. So let me just, throw this thing together and we'll get some people together and have a good time. So this is not going to be super formal. I'm going to show you just some observations that I have about the stock market and about the economy and some thoughts that I have about things going forward. Feel free to, ask a question as we go along. That's more than welcome. We'll have some Q&A at the end, hopefully. But if you think of something as we're going through and you want to ask it, go ahead and put it out there. All right, so let's we're going to go ahead and pull up the PowerPoint here, and let's see. Oh, technical difficulties. Okay, hang on. There we go. Okay. All right, let's go ahead and go through the slides here. So I want to first just anyone who's on the call today who doesn't know about me, my name is Darren Wurz. My company is Wurz Financial Services. I am a certified financial planner, and I have a master's degree in financial planning from Golden Gate University. Every financial advisor is a little bit different. I've chosen to specialize in working with attorneys and retiring couples. We provide retirement planning and investment management. I'm a fee-only advisor, fiduciary, and our firm is a family-based firm, small firm. It's my dad, my brother, and I, the three of us together. And so that's a little bit about us. Okay, so what's happening? What's the post-election market outlook? All right, well, here's what's going on. I want to talk about three main themes. Okay, so we have three themes really that are going to drive the markets going forward. And they're pretty obvious, I think. But we're going to go through them and kind of break down what some of the specifics that we might expect. So first of all, of course, we have the COVID-19 health crisis. That has driven the markets a lot, no question about it, throughout 2020. As the pandemic was starting in February and cases were surging then, markets really went into a big panic, and we had this huge 30% sell-off in the stock markets. And then things started to come back as the economy started to reopen. And we recovered almost all of that. And it's been kind of a weird environment because it's affected people differently. Certain sectors like technology has done extraordinarily well, while other sectors like travel, industrials, and things like that have not done very well. And that's just kind of, the nature of the pandemic. Tech companies have actually had record profits during this time because people have been shifting to remote learning and remote work and different things like that, while other parts of the economy have suffered. So, how is that going to affect things going forward? So the COVID-19 health crisis, of course, we heard the good news over the past couple of weeks. We've got 2 great vaccine candidates coming out. And so there is some light at the end of the tunnel there on that one. So, of course, is the political landscape. We have a new administration that's coming in. Looks like we're going to have mixed control of Congress. What is that going to mean for the economy, for the markets? We'll get into that. And finally, we'll take a look at market fundamentals and trends, just some observations there. Okay, so starting with the COVID-19 health crisis, of course. As I mentioned, we have 2 promising vaccines in final trials. Pfizer came out this week, and second announcement said, actually, we have 95% efficacy in our vaccine, and Moderna last week announcing their vaccine with 94% efficacy as well. Now, that's just 2, and there are tons of vaccines in the pipeline. Those are the first 2 to come out that are looking very, very promising. Pfizer said it's going to look for emergency use authorization here in the coming days. And so most people are expecting that vaccines will be available for healthcare workers in about a month. So that's very good. And, however, it is going to take some time to get that to the rest of the public. Now, the vaccine itself and the reopening of the economy, I know everyone's had a lot of questions about what the election means, what politics means for the stock market and for the economy. But I think the vaccine and the reopening of the economy is going to be more potent, more market and economic changing than anything else that we're going to see. So it's very exciting, very good news. As we see this continued economic reopening and recovery, I think that's going to be very positive for the markets and very positive for the economy. Of course, that makes sense. But there are some caveats, of course. Like I said, it will take some time to distribute that to the public. And most people are expecting that any kind of vaccine is not going to be generally available to the public until mid-year 2021. So we still have a ways to go. And the other thing, too, is there are some logistical challenges. You may need more than 1 dose of the vaccine. Some of these vaccines have to be kept in very cold storage. You have some other challenges like that. And of course, that's great. We've got that light at the end of the tunnel. That's very good. We're happy about that. However, it could be a while before things are really looking very good. Right now, we have, COVID is spreading around the country very, very rapidly. We had our second wave during the summer, and things, we had a big increase in new infections, bigger than the first wave. But now the current wave is just astronomical. And so you can see here the first chart on the left-hand side, the daily new cases. I'm sure you're familiar with that. The good news, however, is we're not seeing a similar increase. Of course, there are still a lot of people dying from this disease, but the rate of death is not increasing as exponentially as the rate of infection. And that's because doctors are better now at treating it. They're better at dealing with it. And they've learned some things along the way. But the way things are trending, we do see a lot of cities are going back into shutdown mode, either having actual stay-at-home orders put in place. Some locations are actually putting in stay-at-home orders. Other locations, like the state of Ohio, are just putting in a curfew, so you have to be in at a certain time, things like that, to try to minimize the amount of restaurant and bar activity that's going on. But without a doubt, these new restrictions, even if it's not as severe as it was in the spring, it's without a doubt going to have an impact on economic activity. We also see public schools shutting down in some areas. New York City announced that they're shutting down their public school system again. The school where my daughter goes, they're going back into shutdown mode again. So and that's indefinite. So they're expecting that, through the end of the school year, it's going to be remote learning. So that's a little bit concerning, and it's going to take some more, time to get through this crisis. However, the stock market right now, even though we're seeing some new restrictions go on, the stock market really doesn't seem to be reacting quite like it did in the spring. So I'm hopeful that investors are kind of, looking through this difficult time period to, and bridging that until, the vaccine is distributed and we come out of this. So investors might actually just be kind of ignoring this time period, looking through to the middle of next year, late next year, when we start to see some kind of return to normal. At least that's what I am hopeful for. Speaking of restrictions and the economy, just wanted to throw this chart up there. This is a graph of U.S. GDP. As you recall, when we had those shutdowns in the first quarter, second quarter of this year, that obviously had a huge negative impact on GDP, and we saw this enormous plunge in GDP. It was a 33% on an annualized basis. And then, of course, as the economy started to reopen, we had this V-shaped recovery and GDP started to come back. Now I'm curious, right? Is this going to continue to move positive? I'm kind of thinking, if we have new restrictions coming in, we could see a little bit of maybe a second dip and then, a recovery afterwards. So that's kind of what I'm anticipating. And you'll notice, even though we had record-breaking GDP, reports about a few weeks ago or so for the third quarter, we still did not even really come close to the peak that we reached pre-pandemic. So there's still a lot of economic recovery yet to go. So we want to keep an eye on that for sure. And then, we're starting to see this kind of reflected in some of the GDP forecasts. On the left here, we have the New York GDP forecast, New York Fed GDP forecast, and you can see that has been trending lower over the past few weeks. It'll be interesting to see how that continues to go here as, they update that going into the end of the month. However, the Atlanta Fed is kind of saying the opposite. So the Atlanta Fed, their GDP tracker has actually been going up. So it's difficult to say, and predictions are oftentimes useless. So we'll see what happens there. All right, so that was dealing with the health crisis and its impact on the economy. Now let's talk a little bit about the political landscape. Okay. So, there's a lot of different factors to look at here. Number one, we have, now that the election is over, we have removed a big element of uncertainty. Okay. Now, markets are weird. So sometimes they like good news, sometimes they don't like bad news. Sometimes it's the opposite, and oftentimes what we see is markets just like news in general. They just don't like uncertainty. And so, one positive thing here is that we have a big element of uncertainty that has now been removed. Now, granted, there may be some transition risk still to come because we've got this transition period where things are still very politically difficult. We have a lot of tensions, there's a lot of craziness going on. But anyway, there is a big element of uncertainty that has gone away. And a reduction in uncertainty is a positive thing for the market. So we had this huge rally, right after the election. And, everyone, there's always all these predictions about what the market's going to do if this person wins or if that person wins. And then everybody wants to make conclusions about what the market does and what that means, and it's really difficult to say. I think that a lot of the rally that we saw right after the election had more to do with simply the removal of an element of uncertainty. So there you go. So now we have a new administration, the Biden administration. We're likely to see more government spending. You may feel a certain way about more government spending one way or the other, but generally more government spending is good for the economy. So that's a potential positive. And we are likely to see gridlock remaining in Washington. Now, obviously, we still have these Senate runoffs in Georgia that could determine the balance of power in the Senate. From my perch, it looks likely that Republicans will retain control of the Senate and that we'll still have this gridlock in Washington where Democrats have the House and Republicans have the Senate. So we'll take a look at what that might possibly mean. Okay, here's just some possible thoughts on what a Biden administration might mean. Obviously, the COVID policy, that's something that they're going to be attacking pretty hard. You'll see a lot of increased funding for that. The Biden administration has expressed that they want to expand the Affordable Care Act. So there could be an increase in the subsidies that families get. So those two things might be a positive. They have talked about taxes, and the Biden administration has said that they would like to repeal the Trump tax cuts in 2017. That would mean a possible increase in corporate taxes and Social Security taxes for high income earners. However, they're going to need Congress to do that. And so if you still have gridlock in Washington, that may not come to fruition. Obviously, increasing taxes on corporations could potentially have a negative impact on economic growth, could have a negative impact on the stock market. That's a possibility. So that's something to keep in mind. Climate is something that the Biden administration has really emphasized a lot. They want to spend $2 trillion fighting climate change. Again, they're going to need Congress to do that, but that is something they have advocated. Now, whatever your thoughts are on climate change, there's a couple things. Increased regulation could hamper some business activity. However, increased government spending could be a net positive for the economy and for the stock market. So there's some competing ideas there. Technology, and this is something from both parties, both Democrats and Republicans have said they want to have greater oversight of technology companies because tech companies have just gotten so big and so powerful, and they have so much influence over much of our lives. And so I think that's something that's likely. Even if you still have gridlock in Washington, I think that's something that the parties might agree on, and that potentially could be a negative for the tech sector, possibly. Finally, we have trade. The one story of the last 4 years has been the trade war with China. Very curious to see where that goes. I'm not sure what the new administration will want to do with that, if they're going to keep those tariffs in place or try to reverse those tariffs. It'll be interesting to see. I think there's my sense tells me that there's more of a likelihood that there'll be an easing of the trade war, and that could be a positive in the short term for economic activity. However, that's kind of an unknown there, so we're kind of unsure what might happen in that arena. Now, all that being said, I want to point out, and I did a blog post on this a couple of months ago, showing what the S&P 500 has done under various presidents, under Democrats, under Republicans. And so you can see in one glorious chart here, it really doesn't seem to make much of a difference. Every president has different policies. Those policies affect different industries, and without a doubt, who's president has an impact on the economy. But by and large, if we look at the grand scheme of history, it really hasn't seemed to matter much who controls the White House. The stock market in general has just continued to go up. Of course, we've had some dips along the way, but there's really not a major correlation there. And then the same thing for congressional control. I'll show you in a second here evidence that might suggest gridlock is good. Certainly, times of gridlock have been good for the markets. However, you have on this chart, you can see periods where Democrats controlled Congress, periods where Republicans controlled Congress, and periods where it was mixed, right? And there's very little we can really deduce from this. It's really hard to say, what impact any particular party controlling Congress is going to have, at least from this perspective. There is some data that, now you have to take this data with a grain of salt because it's not necessarily predictive, right? This is an observation, right? It doesn't necessarily mean this is going to be the case. Hey, if it is the case, I hope so, right? But this shows you the average S&P 500 returns based on who controls the White House and Congress from 1928 to the present. Interestingly, the best years for the S&P 500 have occurred when you had a Democratic president and a split Congress. So that's what we think we're going to have. And if that's the case, and if this precedent holds true, should be a great time to invest. Now, whether or not that actually happens, we will see, right? You have to take this with a grain of salt. But, kind of interesting, different things here. This is, obviously 1928 to the present seems like a long period of time, but it's really not a great, it's not really a scientific amount of time. You would want to study this over a much longer period of time because there really haven't been that many presidents. There have been quite a few, but not, a statistically significant amount. So anyway, you see a lot of people talking about gridlock being good for the markets. This is what they're talking about when they say that. And I think the main idea there is gridlock means things are going to pretty much stay the same. And when there's not a lot of change, the stock market tends to like that. So if things kind of stay status quo, investors tend to favor those time periods. Okay, we're done with politics. I promise. Okay, let's talk about market fundamentals. All right, so this is our last thing here to go through. So a couple major points I want to highlight. Number one, markets are fundamentally overvalued. And I feel like a broken record because we've been saying this for a couple of years now. The thing about overvalued markets is they can stay overvalued for a long period of time. But that is the characteristic that we have. It doesn't mean the market's necessarily going to go down. We're not going to, it doesn't necessarily mean a doomsday is coming, but that is a fact that we have to deal with. A couple other observations. Tech seems to be the most overvalued. We have this potential rotation trade that may negatively affect tech. I'll show that to you, explain what that is. Gains may be more selective from here going forward. We had this huge roaring rally out of the lows of March to today. And, if you missed it, you missed the big gains, right? The easy gains. And now the job might get a little bit more difficult. And lastly, of course, the Fed. I mean, the Fed is really one of the biggest drivers of the market right now. The markets are very controlled by the Fed. And so, with the Fed has indicated that they're very likely to remain very easy, very accommodative, and keep rates low. And so the Fed really has a vested interest in trying to push the markets higher. And it seems like they're going to continue to try to make that happen. So why is the market overvalued? Let's take a look at a couple charts here. First one, on the left, we have, and I don't know, maybe if my left and my right might not be yours, so I apologize. But anyway, over here, we have on the left the Buffett indicator. Okay, this is the Buffett indicator invented by none other than Warren Buffett. The Buffett indicator takes the total value of the stock market and divides it by the value of GDP, okay, to determine whether the market is overvalued or undervalued, okay? Right here, right now, the ratio of the total market value to GDP is 175%. It's the highest that it has ever been, ever. Higher than it was at the peak of the tech bubble in the late 90s, 2000, right? So from that perspective, the market seems to be very overvalued. We hit 150% pre-pandemic, sold off. We got down to 125, but really didn't get, and that felt like a big sell-off, and it was, but we really didn't get to those deep value, to that deep value territory, right? We knocked off a little bit. Things, got a little less expensive, but in the grand scheme of things, we're nowhere near the deep value we had in 08. And then, we just launched up, and that's a result of two things. Number one, GDP declining precipitously and the stock market increasing precipitously. So obviously that ratio just exploded, right? That's one way to measure the valuation of the market. Another is the Shiller price to earnings ratio. That's over here on the right-hand side. And that data goes all the way back to the 1800s. We're very high. We're currently at 32.63. Price to earnings, what is that? That's the ratio of a stock price to its earnings. And so we can look at the ratio of stock prices to earnings for individual stocks or for the overall market, okay? And it's the Shiller PE, which is designed by this guy named Shiller, and he has some extra adjustments that he's made to that. According to this, we are in overvalued territory. We're not the most overvalued we've been, which would have been, according to the Shiller PE, the 2000s peak there, but we're still pretty high. Okay, so two indications there to be aware of. So far this year, over the last 5 years, going back 5 years, the U.S. stock market really has been the leader, and especially over the last couple of years, right? So here, 2018, the U.S. market really started to break free. We have the U.S. market represented by the S&P 500 in blue. We have emerging markets in pink. We have international stocks in purple, representing the developed world, okay? So, as the trade war started, we kind of saw the U.S. market kind of elevate and emerging markets decline. China is a big portion of emerging markets. And so that kind of makes sense there. But this is interesting. I mean, this trend could continue, and trends do tend to continue. We call that persistence. Trends tend to persist. And so, this is likely to continue. We're likely to see the U.S. market continue to outperform. However, at a certain point, this is going to change, right? At a certain point, there is going to be a reversion to the mean, and we are going to see international stocks, emerging market stocks start to pick up again. And we might already be seeing that a little bit. If you'll notice, over the last few months, the U.S. market, this S&P 500 has really been kind of flat, whereas emerging markets have increased pretty dramatically and international stocks have increased pretty dramatically during that time period. So we're seeing a little bit of outperformance in international and emerging markets over the last few months. Stay tuned to see if that continues. All right. Okay, and then let's take a look at some pieces of the US market, right? And so here we have a couple different things, a couple different components. In yellow, we have the NDX, or the NASDAQ 100, which is the 100 biggest tech companies. Now, obviously, this is just fascinating, incredible, right? Over the last 3 years, really, tech has just been on a tear and has outperformed everything, especially during the pandemic. So for 2020, I mean, tech is up just an insane amount. Over the last 5 years, increasing by 153%. And then in blue, is the S&P 500, just completely dwarfing the S&P 500 by comparison. So, and a lot of that is the result of, the pandemic, right? You had this huge influx of capital into tech because investors were, looking at the pandemic, seeing that there's going to be a lot more working from home. There's going to be a lot more technology usage. And so because of that, you had a lot of inflows into technology and a lot of people buying technology. And the other thing too, the government sent out stimulus checks, and a lot of people didn't necessarily need those stimulus checks, decided to invest that money. And evidence shows that a lot of that money was invested in some of those big tech names that are really popular. Facebook, Apple, Amazon, Netflix, Google, Tesla, things like that. Okay. Then, lagging, we have the Russell 2000 in red, which represents small caps, and small caps have really been lagging. If you see here, small caps have not gone anywhere for about a year and a half. They have really been very stagnant, just now peaking out to some new highs. So small caps have really lagged. A big part of that is because a large part of the small cap index is financials, and banks, bank stocks, financial stocks, value stocks have really lagged behind the big growth names like tech and other things like that. Now, on the complete opposite end, right, we have energy, and energy has just gone down for 5 years. I mean, it was very stagnant, and then it's just been a steady plod lower, especially over the last year as the pandemic was ensuing. And here we are. I mean, energy is just in the toilet, has been in the toilet for a long time. Now, who knows? This might be a turnaround play. Energy might be ripe for investment at this point because it is so beaten down. That's a possibility. However, I would caution you, losers tend to stay losers for a long period of time. A lot of people thought back in 2017 that energy was lagging and they should invest in it. And boy, did they, if they hung on, boy, are they kicking themselves at this point, right? So it's tough to say when those turnarounds come. Is there too much tech? This divergence in the market has really created some weird, wacky things. Energy as a percentage of the S&P 500 is almost disappearing. It's becoming so small. And on the opposite end, technology, because of this growth, because the share price and the value of these companies has exploded so much, it's representing a bigger and bigger proportion of the S&P 500. The top 5 stocks, Microsoft, Apple, Amazon, Google or Alphabet, and Facebook, represent 23% of the entire S&P 500 index. That's crazy. A fifth of the entire index is piled into only 5 companies. That is an incredible level of concentration. The last time we saw a peak anywhere like this was in 2000. You had Microsoft, GE, Cisco, Intel, and Walmart, the top 5 then, representing almost 19%. And then you see what happens. So this tends to ebb and flow, and people who are on the tech ride, it's fun while it lasts, but at a certain, it's not going to keep going like this forever, folks, right? If you extrapolate this out, you'd get to 100% really, really fast. And I just don't think that that's going to happen. Now, I could be wrong, right? But I think tech has gotten a little bit ahead of itself, and this chart would argue for that. Okay. Oops, what did I do? Okay, bring back my my slideshow. There we go. All right, so a couple other observations here. Corporate profits have really been stagnant. These are after-tax profits, and you can see it hasn't been updated, so we only have second quarter numbers, probably somewhere in here, kind of like GDP is. But really, for the last 8 years, corporate profits, conglomerately, have really been stagnant, and this is a troubling sign for the economy. The stock market has soared, but true, real economic growth has really been pretty lackluster almost for a decade. And so we really need to see some real, genuine economic growth to push markets higher. Like I said, we saw the charts showing how overvalued the market is. That can only continue for so long until you have real, true economic growth. So we need to see some of that. So what's driving the market? Well, a lot of people would think that and argue, and I might agree for the most part, that really the Fed, the Fed has been the driver of the market. Pre-2008, the Fed kept a balance sheet, meaning that it owned a certain amount of debt, but that pretty much stayed pretty steady. And then in 2008, when the great financial crisis hit, the Fed decided that one way that it could support the economy was to go out and buy securities, okay, and buy debt in the open market. And so they started to do that, right? And everyone went crazy about the amount, the size of the Fed's balance sheet during the financial crisis. Well, look at it now. It makes the 2008 crisis look like a bunny hill in comparison. The Fed has gone bananas, right? And so, this is something to keep an eye on, because this can't continue indefinitely. At a certain point, the Fed tried to normalize, right, very briefly in 2018, and then the market tanked, and then they said, okay, forget about that. Will they ever normalize? I don't know. It's very interesting. It's a little bit concerning that this is the background we have, and really this is a primary driver of the markets here, is this balance sheet expansion, because the Fed has pumped so much liquidity into the markets. And this is something to keep an eye on. It works as long as it works. But at a certain point, when do investors start to get concerned about true valuations? When do investors start to get concerned about this? And when does inflation start to rear its head? Right? When that happens, you might have a problem for the Fed to deal with, because they might not be able to be as accommodative as they want to be. Okay, so I've talked a lot and running out of air. But anyway, so just to summarize some positives and negatives, we don't know what the market is going to do, but here's the environment that we're in, right? There are definitely some great positive signs. Vaccines being developed, really good vaccines being developed that are going to soon be available. We have the continued reopening of the economy going on. And as that continues to happen, the market will continue to grow, and we'll continue to see that economic recovery. We're likely to see more fiscal stimulus because of the new administration and more government spending. Gridlock in Washington is a potential positive, and the Fed is going to keep interest rates low. So a lot of really good positive factors. Now for the negatives, there are some negative things that we have to keep an eye on. COVID is surging. We see that right now, and we're entering this third wave. Who knows how this will end? The next few months are going to be very, very difficult for a lot of people, very difficult for our country, and could be difficult for the markets. New lockdowns and restrictions will restrict business activity. All this is happening amidst a backdrop of overvalued stocks and a potential rotation out of tech. And so I forgot to mention this. A lot of folks invested in tech of the pandemic, because there was this expectation that tech companies were going to benefit from this more work from home environment. Now we're starting to see potentially a rotation out of that trade. So it's been interesting over the last couple of weeks. We've really seen the broader market start to outperform technology. We've started to see some great performance in energy and materials and industrials, and some lackluster performance in technology. Now, is that going to continue? I don't know. I mean, they've been talking about rotation out of growth and into value for like 5 years, and it hasn't happened. So I think, in my opinion, there'll be some turbulence, but I think tech is going to continue to do reasonably well. I don't think it's going to be a major problem. However, if a lot of people rotate out of tech, because tech is such a big percentage of the market, that could have a negative impact on the broader market. Also, we have lackluster corporate profits. That's been a phenomenon that we've seen for the last several years, almost 10 years. And then we have this Fed balance sheet and the explosion of government debt to deal with. So, a lot of positive signs, but there are some short-term, very big negatives. And then there are some structural negatives that we need to be aware of, like the stock market being overvalued, the Fed's balance sheet, things like that. All right, so that's the summary. I want to give you a quick view on things we like, things we don't like. Our philosophy, the way we manage portfolios, is tactical, which means we make adjustments based on what's happening in the market to try to take advantage of trends, to try to avoid major downturns. So we adjust things. And things we like, we're overweight on U.S. equities, international bonds, and technology. International equities in emerging markets especially. And we're starting to see a little bit of outperformance in international equities. It'll be interesting to see if that continues. Maybe, maybe not. International stocks are not as richly overvalued as U.S. stocks. So there is maybe some more potential there. But we still like technology. Even though the things I outlined for you, these tech companies are cash cows. I mean, they are very profitable, and we don't see that necessarily ending. We are underweight things we're not so in love with: treasuries, gold and commodities, corporate bonds, and real estate. Real estate's really been a tough one. Real estate's really been hurt very hard by this pandemic, especially commercial real estate, obviously, because things like malls, are just not happening right now. And that will eventually turn around, but it's going to take some time. And that's happening at a time when retail was already kind of in decline. Malls around the country were already in decline. JCPenney was already in serious trouble before all of this happened, right? So don't necessarily see that changing too much. Okay. Are you looking for help? So just want to throw this out there. We can help. I can help you navigate these changing, crazy times if you need that help. We provide active investment management, like I said, that adapts to market conditions. And so, when things start to get ugly, we are going to reduce risk. When things are looking good, we're going to increase risk and try to, accelerate that growth. We use a variety of tactical strategies that are designed to harness the power of trends, quantitative models or numerical models that reduce risk proactively during crises, and actually did very well this year and very well through the big sell-off that we had earlier this year. We were actually up, which was nice. So if you need some help with your portfolio, I'd be happy to talk with you. You can give me a call for a free portfolio review. Or you can use that link there, calendly.com/Darren Wurz/30min, and sign up for a free 30-minute time to talk with me. And that's pretty much it. I've got my contact information here for you: our website, Facebook, Twitter, phone, email, etc. And I'm happy to take any questions. So don't be shy if you have a question. shout it out, put it in the chat box there. You can click, if you haven't opened the chat, there's a little button up in the right-hand corner. You can click on that button. It'll open the chat box, and you can type in a question if you have one, and I'll be happy to answer. So no pressure. Let's get some questions. Who's got a question for me? Give me a softball. And while we're waiting for some questions, if you'd like to do a portfolio review, you can, of course, go to that link, calendly.com/Darren Wurz/30min. I'll be happy to look over your portfolio, give you my feedback, compare it to what I'm doing with my clients, and give you some suggestions that might be helpful to you. We use TD Ameritrade to manage portfolios. They're a great platform, very easy to use, open platform, no commissions, which is nice. Very, very great platform. Any questions out there? You guys are a quiet bunch. Feel free to type a question in the chat box. I'll take a question from anyone if you have a question. We've got a great group on the call today. I hope this was valuable to you. You know, I can't necessarily predict, of course, where the markets are going to go, but you know, there are some definite key observations to be aware of, and it'll be interesting to see where things go from here. You know, like I said, we do have some big structural challenges. I mean, the debt alone is going to be a big challenge going forward. The amount of government debt, not just in the U.S., but around the world, the amount of government debt that is built up is going to be a big challenge economically, structurally for markets and to deal with. But there are some, you know, very good backdrops. I'm very optimistic about 2021. If nothing else, than to simply turn the page on 2020. This has been really a trying year, I'm sure, for all of you, for me, for everybody. All right, well, I'm not getting any questions, and that's totally fine. I'm not offended. No worries. One last chance to ask a question. If you got one, you can type it into the chat box, and I'll take that question and answer it the best I can. If not, that's okay too. I want to thank all of you, each of you individually. I want to thank you for joining me today on this call, spending a few minutes with me. I really appreciate your time. It's been a pleasure to give you my thoughts. Thank you so much. I got a comment there from Zach. Says, I covered everything too good. I certainly appreciate it. If you think of anything, if you have any questions, feel free to, afterwards, feel free to send me an email, connect with me on LinkedIn or what have you. And of course, if you'd like a free review of your current portfolio, I'd be happy to do that with you also. All right. Thank you so much for joining me. I wish the very best for you and for your family, especially as we head into this holiday season. Please be safe and stay healthy. And hopefully I will see you again soon. Thank you so much.